Today, we're breaking down a comprehensive analysis of persistent systems. We're going to peel back the layers, look at the engine that makes this company run, and really try to understand the anatomy of a top-tier tech stock. It's the classic investor's dilemma, isn't it? You can find a fantastic business, great products, happy customers, but that doesn't automatically make it a great investment. The price you pay for it is everything. And that's the central question we're digging into today, using persistent systems as our case study. So, to really get a handle on any company, you first have to understand the world it operates in. For persistent systems, that world is basically a massive, ongoing digital gold rush. And here's the thing, they're not the ones digging for gold, they're selling the picks and shovels. What you need to grasp here is just the sheer momentum. Businesses everywhere are in a flat-out race to modernize. They're moving to the cloud, they're adopting AI, they're digitizing their operations from top to bottom. This isn't just a passing trend, it is a fundamental economic shift, and it's creating this huge, sustained wave of demand for exactly the kind of expertise Persistent provides. So, in this booming market, who exactly is Persistent Systems? Well, they're not just another IT shop. They're the specialists, the experts you call when the job is really complex and absolutely mission-critical. Let's take a look at what that actually means. Their core business is building the digital engines that other companies run on. And we're not talking about simple little apps here. These are the complex software products, the core systems that are the lifeblood of a business. Persistent's team are the architects working behind the scenes, making this whole digital transformation thing a reality. And you can see that expertise reflected right here in where their revenue comes from. I mean, look at this breakdown. Banking and healthcare make up the lion's share. These are industries where technology has to be absolutely rock solid and super specialized. This focus allows them to build deep, defensible market positions in these really high-stakes sectors. A great story is one thing, but does the math actually back it up? This is where we pop the hood, put the company under the microscope, and check its vital signs. So let's see what the financials are really telling us. First off, let's look at revenue growth. An average of over 18% per year for 5 years straight. That's not just strong, it's incredibly consistent. It's the clearest signal you can get that their services are in high demand and they are absolutely winning in that digital gold rush we talked about. Now, here's where it gets really interesting. Profits are growing even faster than revenue at over 22% a year. What does that mean? It means this isn't just growth for growth's sake. The company is actually becoming more efficient and more profitable as it scales. And that is the hallmark of a really well-run machine. And this number, return on equity, is just a fantastic indicator of management quality. An ROE of 18.5% means that for every single dollar of shareholder money invested in the business, the management team is generating 18.5 cents of profit. That is an excellent return, and it just shows how effective they are with their capital. And then we have this. Two simple words with profound implications: zero debt. Persistent funds all of its impressive growth from its own cash flow. In a world of leverage and risk, this gives them incredible financial stability and the flexibility to weather any storm or seize any opportunity. It is a rare and powerful position to be in. So we've established that Persistent Systems is an exceptionally high-quality business. The numbers are fantastic. But this brings us right back to our original question. Does a great business automatically equal a great investment? This is the core conflict every single investor faces. Let's look at this peer comparison. The PE ratio, a common valuation metric, is at 40.8. That's higher than its competitors. The market is asking you to pay a premium, but why? Well, look at the other two rows. Persistent is delivering significantly faster growth and a much higher return on equity. That higher price isn't arbitrary. The market is telling you that you have to pay a premium for this level of quality and superior performance. And that leads directly to the bull versus bear debate. The bulls will point to that massive digital trend, the company's specialist position, and its flawless financial record. The bears, on the other hand, will point to that high valuation, arguing it leaves very little room for error. They'll also highlight the risks of competition and a potential economic slowdown. And you know what? Both sides have valid points. So, after weighing all the evidence, the strong fundamentals against the premium price, where does the analysis land? Let's pull all these threads together for the final verdict from the source report.
The analyst's weighted average target price comes out to 5,725 rupees, which suggests about a 9.2% upside from the current price. The verdict is a buy. but a disciplined one. This isn't a screaming bargain, it's an acknowledgement that quality often commands a premium.
Ultimately, the investment thesis rests on these four pillars: a top-quality, debt-free business in a strong market, run by a proven team, and perfectly positioned for the future. The core bet is that this fundamental quality will continue to drive value in the long term.
And that leaves us with the final question, which is really the most important one for any investor. We've seen the evidence, Persistent is an A-plus company, but the price for that quality isn't cheap. So it all comes down to a personal decision. For a business this good, what premium are you willing to pay?